As the markets in Taipei trade, Taiwan Semiconductor Manufacturing Co Limited, ticker TSM, is currently trading at 1,485.00 new Taiwan dollars, reflecting a solid gain of 20.00 TWD or 1.37% for the session. Now, seeing that green number, the immediate thought for most is simple. The world's most important company is doing what it does best: winning. The expectation is that this uptick is just another data point in a long, inevitable march upward, powered by its unassailable lead in producing the world's most advanced microchips. But the reality of today's price action is far more complex and fragile than that. This isn't just about a good day for tech, it's a reflection of a delicate balance between its incredible operational strength and the immense, ever-present geopolitical pressure cooker it lives in. What most people miss is that the stock is no longer trading purely on its technological prowess. It's trading on a risk premium that shifts with every headline out of Beijing and Washington. Let's be clear, the common ground we all stand on is the understanding that TSMC is the backbone of our digital world. The chips in the smartphone you might be watching this on, the processors powering the servers that delivered this content, and the GPUs rendering advanced graphics for AI, they almost certainly came out of a TSMC fabrication plant. Companies like Apple stock, Nvidia stock, and AMD are design powerhouses, but they are fabless. They are architects who hand their brilliant blueprints to a master builder, and that builder is TSMC. This creates a powerful narrative of indispensability. The belief is that as long as technology advances, TSM will prosper. It's a simple, compelling story, and for a long time, it was all that mattered. Many investors using platforms from Fidelity to SoFi Invest bought into this story, making it a core holding in countless portfolios, from sophisticated Schwab Intelligent portfolios to simple individual brokerage accounts on Robinhood. But here's the challenge to that thinking. This indispensability has also created the world's most critical single point of failure. The company's extreme concentration of manufacturing in Taiwan, a geopolitical hotspot, means its operational perfection is perpetually held hostage by political instability. The market has begun to price this in, not as a distant, abstract risk, but as a clear and present variable influencing daily trading. Today's 1.37% move up is illustrative. It's happening on moderate, not spectacular trading volume, suggesting a cautious optimism rather than a flood of conviction. This isn't a rally driven by a blockbuster product announcement or a blowout earnings report. Instead, it's more likely tied to subtle shifts in the macroeconomic and political winds. Perhaps it's a slight cooling of inflationary fears in the U.S., which hints at stronger consumer demand for electronics down the line. Or maybe it's a temporary lull in aggressive rhetoric across the Taiwan Strait. Retail investors on the Robinhood app might see this as a buying opportunity, while more seasoned traders using the advanced tools on interactive brokers' trading platforms are likely parsing the nuances of the order flow and option activity, looking for signs of institutional hedging against downside risk. Speaking of institutional activity, the big players are in a constant state of reevaluation. While many large Fidelity mutual funds and ETFs maintain significant positions due to TSMC's sheer market cap and importance, their portfolio managers are also actively managing their exposure. We've seen periods where funds trim their positions on any sign of escalating tension, only to buy back in when things calm down. This creates a floor and a ceiling for the stock that has less to do with its price-to-earnings ratio and more to do with geopolitical risk modeling. The Fidelity Wealth Management advisors are undoubtedly having complex conversations with high-net-worth clients about how to balance TSM's growth potential with its unique set of risks. Looking back at the reaction to its most recent earnings report gives us more insight. The company delivered solid numbers, beating expectations on both the top and bottom line, with guidance that signaled continued strength in the high-performance computing HPC segment, largely driven by the AI boom. The initial reaction was positive, but the stock gave back some of those gains in subsequent sessions. Why? Because during the analyst call, management spent a significant amount of time discussing capital expenditures for its new fabs in Arizona and Japan. While this global diversification is exactly what investors want to see to mitigate geopolitical risk, it comes at a staggering cost and with lower profit margins than their Taiwanese operations. The reality is that de-risking the company geographically means, at least in the short to medium term, denting its legendary profitability. This is the central tension. The solution to its biggest problem creates a new, smaller problem. This is a level of nuance that simple online investing guides often miss. Effective investment help has to go beyond the surface-level numbers. What TSM actually does, for those who might be newer to self-investing, is operate as a pure-play semiconductor foundry. This is a critical distinction. Unlike Intel, TSM doesn't design its own branded chips. Its business model is to be the best manufacturer for hire on the planet. A company like Apple designs the A-series Bionic chip for the iPhone, and then it pays TSM billions to fabricate tens of millions of those chips with exacting precision. Its dominance comes from its multi-decade focus on perfecting the manufacturing process, allowing it to consistently be the first to market with the next-generation process node, moving from 7 nanometer to 5 nanometer and now to 3 nanometer and developing 2 nanometer technology. Each step down in nanometers allows for more transistors to be packed onto a chip, making it faster and more power efficient. This technological lead is its primary moat. Revenue is broken down by process node, with the most advanced and most expensive contributing a huge chunk of sales. It's also broken down by application, with HPC, thanks to AI, and smartphones, thanks to Apple, being the two largest segments. This is a far cry from the more diversified business of a company like Samsung, which is both a competitor in the foundry business and a major customer in other areas. Looking ahead, the future outlook presents a fascinating duality. The biggest catalyst is undoubtedly the ongoing explosion in artificial intelligence. The complex GPUs designed by Nvidia stock are built on TSMC's most advanced processes. As the world builds out AI infrastructure, the demand for TSM services is set to be immense. This is a powerful secular tailwind that could drive growth for years. Another positive catalyst is the successful expansion of its global footprint. If the fabs in Arizona and Japan can ramp up production smoothly, it will go a long way toward reassuring investors that the company is not a purely Taiwanese bet. Many Fidelity ETFs and SoFi ETFs are structured around these long-term growth narratives. However, the risks are equally potent. The primary risk remains the geopolitical situation. Any escalation of conflict could be catastrophic for the company and the global economy. Secondly, there's the customer concentration risk. Apple accounts for over a quarter of TSM's revenue. While the relationship is symbiotic, if Apple were to seriously diversify its supply chain, perhaps by giving more business to a resurgent Intel or Samsung foundry, it would be a major blow. This is something that anyone considering an invest online strategy needs to monitor closely. Finally, the cyclical nature of the semiconductor industry cannot be ignored. The current AI boom is strong, but a global economic slowdown could still dampen demand across the board. Comment below with your thoughts. Do you believe TSM's global expansion will be enough to meaningfully reduce its geopolitical risk premium over the next 5 years? In summary, the story of TSMC is no longer just about flawless execution and technological leadership. The expectation that it is a straightforward tech investment has been replaced by the much more complicated reality that it is a geopolitical asset with a tech business attached. The green number on the screen today is a testament to its immense strength, but the underlying volatility and the constant chatter about risk underscores its profound vulnerability. The market believes in its technology, but it remains deeply uncertain about its geography. Understanding this tension between its perfect silicon wafers and the imperfect world they are made in is the key to truly understanding the value and the risk of this incredibly important company. This content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. This content is not a taxable event and 0% accurate according to the stock market. If you found this helpful, don't forget to like, comment, and share. Like, comment, and share. Stay smart with your money. Like, comment, and share.